Welcome to the podcast, everybody. Thank you. Appreciate you joining me here today. The stock market just closed, and as you can see, a lot of green on the screen. The Dow Jones up about 135 points. Transports, which a lot of people were concerned about, the old Dow theorists, it had been leading the way down. Obviously, you can see very strong today, up 2.65% on the day. The S&P 500 up 1.6. Of course, small caps 2.25. Biotech, which have been strong. Financials kind of lagged a little bit. We'd like to see them leading if you're a bull. NASDAQ 100 is strong, obviously because of Apple. Oil service stocks, very strong, 3.85% today, really the strongest, one of the strongest areas. But pretty green all the way across the board today. So we'll start off with the S&P 500. As you know, I did a podcast on Saturday. It's kind of rare for me to do one over the weekend, but I thought it was timely. And I pointed out in there that, bonds were looking overbought and stocks were looking oversold. And so I had actually covered the loan short position that I had, which I had used RWM, which is a Russell 2000, not a leveraged ETF, just a standard. It's supposed to move 1-to-1 with the Russell 2000, and so as the Russell goes up, this went down and vice versa. And as I told you on Saturday, you have to cover your shorts, or in this case, sell your inverse ETFs. You have to do that at times when you may not want to. And I actually did that Friday, and if you were to look at this picture, and we talked about this on Saturday's podcast, you could easily say, look, this thing could go up to here, so why'd you sell it now? And as I pointed out, what happens is, because we're so oversold, those gains can evaporate very quickly in these inverse ETFs, even on the single ones. So I went ahead and sold mine on Friday kind of into the carnage, knowing that at some point we're going to rally. The whole question was what kind of rally were we going to get. And you can see the Russell 2000, this ETF was down 2.37% today, which means the Russell was basically up that much. And so look, had I held on, it would have given up Friday's gains and half of Thursday's gains. And here it is going down. One more down day, and it's down back over here. So that's why I went ahead and covered that on Friday. And it wasn't because I knew that was the exact precise time, but I knew it was going to be within just a couple of days given how extended everything was. Now, if I knew that was the absolute bottom, I would have gone and leveraged my house and bought as many call options on the market as possible. Markets that are oversold tend to stay oversold, and markets that are overbought tend to stay overbought. But things were so stretched to the downside, and on bonds they were stretched to the upside, that we knew some type of rally was going to happen, and that's exactly what did happen today. And the stock market, being up 134 points on the Dow, 20 points on the S&P, about 1.5%, pretty strong day. However, it was only about 83% of the volume on the New York Stock Exchange was upside volume. And that may surprise some of you because you would have thought perhaps it would have been a 90% upside day, which is one of those bogey numbers that we try to watch and say, is this a place where 90% is kind of that number where you say everything is moving in one direction. With 83%, it's a good day, but what you have to have is you have to have a string of those put together now, because a 90% up day is a very, very strong day. 83%, obviously strong. It's just, it may not catch the attention of just everybody. So that's something to watch. Can we get another 80% up day tomorrow, or is this just simply a bounce? And right now, all you can say is it's simply a bounce. We did get this kind of volume, maybe a climax on Friday, and so that was finally some tossing in the towel we saw. And so I covered the short on Friday. Really the only thing I did today was basically I bought some Apple. I had sold Apple, as you guys know from listening to the podcast a while back, and of course it kept going up even after I sold it. Didn't chase it, started to see some negative things. Earnings were really good, and of course it had that big gap up, back in, I guess this was April 25th or so, had the gap up, came down, kind of hung around, and I said, hey, maybe this is a good spot. Still didn't buy it at that point. Of course, because the market was so bad, the market fell, as did Apple. The volume increased, but the 100-day moving average, which was breached on Friday, but recovered. Apple had a decent day on Friday, and it came back today, and I bought it midway through the day. You can see here, this is a 5-minute chart of Apple, and I bought it somewhere right in this area here, about 545, 546 is where I bought it. It was running up, let it come down a little bit, and then basically bought about a 3% position in my little bit more conservative allocation accounts. Those are the ones where not really looking for a 2 or 3 week trade, kind of feeling like maybe this could last for a while. We have a couple of things happening for Apple, obviously. We've got, not only do we have the iPhone 5 coming out probably in October, but we also have perhaps an iPad mini coming out, and the new iPad is supposed to be a little bit bigger than the existing iPad. Now those are some experimental things going on. There's a lot of new phones coming out that are starting to get bigger once again and having more real estate to work with, but it seems a little odd that you would say, well, we're going to make the iPhone much bigger and we're going to make the iPad smaller. They start to converge, and then there's some there's some cannibalization, right? Because you have some people that want a bigger device than an iPhone now have that device. Why would they go out and buy an iPad? So that's a little bit of an experiment, but Apple has tended to know what they were doing. Of course, a lot of people would say that was back when Steve Jobs was still running the company. But look, I'm willing to give them some leadway, and unlike Facebook, this is a stock that is a very cheap stock, reasonably inexpensive. It's not dirt cheap, but for the growth you're getting right now, it's still cheap. So let's watch this, but 100-day moving average did hold, and so I basically have marked my line in the sand, and I own it somewhere in the 546 range. It was up $31 today, 5.8%. So not a bad day. You see volume starting to, pretty good today, and I just think it was a oversold condition. The next challenge for it, I think, is going to be obviously not only get back through the 20-day moving average, but here's the 50-day moving average. Can this turn around and have this line start to turn back up again? So let's watch Apple here. The market's probably not obviously overbought at this point, but it probably still has some room to go. Now, here we are with the S&P 500, and let me switch back. These are the spiders. Here's the S&P 500, same thing, one more digit on the end. And we talked about this on Saturday, where could this market go? And I think that we have to watch this, that, it was, I think it's likely that we could run up to perhaps the 50-day moving average and fill kind of that gap. Maybe not in a straight line, but it would make sense that we would fill that and then fail. So I'm actually looking to reestablish shorts, and I think if you want to make money in this environment, you cannot be a long-only person. Okay, the shorts I had were more for my trading accounts, but now because the market is so weak in the intermediate and some medium and long-term indicators are breaking down, you have to start considering them for even your more conservative accounts as a position, not just a hedge, but as a position where you say, look, if we're in a down market, how do I make money? Do I just camp out in cash and wait? That's one option. Or do I actually try to make money and be agnostic about the situation, to just turn the charts upside down? What would I do? Well, you would be buying the dips, or in this case, selling the rallies. But I think perhaps bouncing up to that 1350 range would be highly logical, and then we could roll over. It's extremely important, and I have to look at all the numbers today. I haven't gone through all of them. I want to get this out as soon as possible. But to me, when we look at the upside versus downside volume, I'm not real as enthusiastic as I would have thought. If you look at the spiders, look at the volume on the spiders here. What we have is the volume is still underneath the 50-day moving average. So we saw the spike up. What you want to see is you want to see volume up here matching that for 2 or 3 days, because that shows that just shares are being transferred from the weak hands to the strong hands, and it has, and we didn't get that today. So I don't think, I think this is more a short covering rally, and we will see a pop, perhaps 2, 3, 4 days, who knows? But I don't think that was it. I don't think that climax is it, because you would see things like financials leading. What you saw today is the most beaten down stocks leading the way back up. And that's not necessarily abnormal, but I would like to see everything participate, and I'd like to see extremely strong volume, and I didn't see that today. All right, now on Saturday I talked about Facebook, and just briefly in my closing remarks, but we know what happened. There's been plenty of time to digest that. We know it had tons of glitches and people that were buying so many shares, and they were getting filled with twice as many shares, and just a big fiasco. And you could kind of see it. It was delayed. The opening was delayed. The stock opened up around $45, sold all the way down to $38, and of course the underwriters came in and bid this thing up, had $1 billion to keep pushing it back up. And you thought, okay, well maybe the worst is over. Sold back off again and closed right here, or right around $38 where it came public. Nobody knew what would happen over the weekend. I thought perhaps it would settle in a little bit around the $38 range, simply because you had a lot of forced selling on Friday, right? You had people that had a lot of shares given to them, or they bought into the company, whatever the case was, back when they were private. So they had a lot of shares at $1, $2, $3 a share. So at $38, $40, they're going to cash in. So you had a lot of supply coming in here, met by retail demand, people that think the stock's going to 70 and it's the next Google, and it was almost a stalemate. And we come in over the weekend now, and Monday morning comes around, and the stock drops, and drops very fast, all the way down to $33. And then it stabilized, started to run a little bit, and it's now about $34. It's still a very expensive stock, but it has lost that magical thing that all IPOs want. What is that magical thing? It's where the stock comes out at $38 a share, and it ramps up to $55 on the opening day. And the whole weekend, everybody's saying, man, I should have gotten into Facebook. Even if I would have bought it at $42 after it went public, I still had a chance, and I didn't, and it's at $55. I've missed the next Apple, the next Google. I've missed it. And they talk about it all over the weekend, and so what do? They come in Monday, and they just put a market order. Just get me in as fast as possible. And the stock starts feeding on itself, $60, $70, $80. But what happened was, over the weekend, was people were talking about what a disappointment it was. And boy, it sure didn't do anything. And they move on with their lives. Yeah, they may come back to it, but then it also gives people time to analyze the stock. And when I say analyze the stock, I mean to look at some of the fundamentals on the stock. And you start looking at the fact that this is a 100 PE stock. It's a very expensive stock. So it's not a cheap stock like Apple, but it's growing fast. So I'm not going to say it can't be a $50, $60 stock in a few months. Who knows? We still know those institutions that have to own it, they will buy it at some point, and maybe they already have. Who knows? But there's going to be more institutions that have to buy it because it's such a large company. I think it's, at least the other day, 130 billion or something. I don't know what it is now. But the point is that it is a large company. So I'm not buying it. I didn't mess with it. I think, the best you can do for this is let it settle into some price before you go in there. And it hasn't. It settled at $38 on Friday. It settled in at $34 today. Is it going to go to $30 tomorrow? We don't know. It's just a crapshoot. So for me, I look at the IPO history, and most of these things have had a better time to buy it later on. And you're seeing that play out right now. So for me, I don't own any Facebook. I don't plan on owning Facebook. I don't even use Facebook. I do respect the fact of what it does and what it is in our culture, but I don't feel like liking or not liking people. I like everybody, right? And I don't want to have to click I like everybody on there. But the bottom line is, yes, they have a lot of users. How do they monetize that? It could be the best thing the best company coming up. We don't know, but let's let it settle in first, because no question, just because you see 34, that doesn't mean it's a cheap stock. You have to look at how much earnings per share are they generating to justify this price, and it's still expensive. Let's run through a few of these ETFs. I'm basically just going to show you some of the ones that are traded the most. And we can go through the ones that are traded the most, at least today. We go through the biggest, the most popular ones. Let's go through the ones that are traded the most today. And, of course, Spider's leading the way. We've kind of already touched on that. XLF, the financials, didn't really participate, up less than 1%. And once again, you can see the low volume, over here. Not what you want to see. We need to see a complete reversal that makes you say, ooh, I missed the bottom. I do expect it to bounce. It's at the 200-day moving average. The market looks okay for a short-term bounce. But, again, if you're wanting to buy that kind of stuff, I think you can buy it. You're just going to have to keep a tight stop and risk being out of it, literally within a day. So financials didn't participate. The VIX, VXX, if you're somebody that's been riding this up, I think there's a better time, a better way, really, to play the market selling off than to own this. If you're going to own it for a week, maybe two, it works, but we know that this does not correlate with the volatility index over time. So I see this going down a little further, and unlike those other ones we talked about, the VXX actually had high volume. So what that means is we should expect a lower volatility in the next, the VIX coming down in the next few days. Let's move on to the Russell 2000. Of course, as I said, I covered my shorts in the Russell, and the Russell did have a pop today, 2.26%, pretty decent volume. But once again, if you're looking at this saying, well, how high, Karl, do you think this can go? I would just say that, again, we have to look at, for this, not that much higher, right? 77.50. One more good day, perhaps, and then it's got some major resistance there. So, and by the way, we had, not only do we have that resistance there, but we had this head and shoulders here, and I think that's what the market's seeing, and it's now broken down through this neckline. So that's something the market is looking at, saying, look, longer term, this doesn't look good, but this is a reversion to the mean trade. That's what this is about with the Russell 2000. And we really need the Russell leading the way if you think the stock market should turn. Emerging markets, this has been a good short, and I don't look, if you're negative on the market, the emerging markets should be a place in commodities that you want to remain short. But again, when it falls as fast as it did over the last couple of weeks here, especially last week, it's going to bounce. So you could look for it to perhaps get up to this 39 to 40 area and then roll back over again. One of the big volume leaders today, the triple small cap bear, if you want to have a lot of fun or have a lot of pain, this was down 7% today. So live by the sword, die by the sword. This is more of the developed markets, and you can see, again, the place to be short-wise. So we could expect a bounce for a few days, perhaps another $1 or so out of this at least. And the rest are just, some other ETFs as far as inverse ETFs, leveraged ones, etc. Oil services was one that was had a really big day. And a lot of these, I mean, if you look at the components of these, you start looking at the Schlumbergers, which had a question about, was it a good time to buy Schlumberger? And look, and I said in here, I think it can bounce. If you're looking for it for the next 2-3 years, now's probably a great time, down from 80 to almost 60. If you're looking for it for the medium term, meaning the next 3-4 months, I wouldn't buy it here. I think we're going to have a bounce, and we may see some further downside in it. When you start talking about the treasuries, you can see it. We talked about it the other day, I think, in the podcast, how extended this was to the upside. And the amazing thing about it was, and this is something I think if you're bullish, you should be fearful of, is when you look at the volume with this, we didn't have the type of volume, or excuse me, the type of sell-off that you would suspect. I mean, a 0.2% sell-off, right? If you think that the stock market's going to continue to rally, why aren't people just dumping treasuries? Instead, they mildly sold them. So even though these are overbought, you didn't see the mass exodus of money coming out of, and that's interesting because if you don't see money coming out of treasuries to fund the stock buys, where's the stock buy money coming from? It could be just short covering. So think about that because money's constantly rotating. And today it went into the stock market, but it didn't come out of the bond market necessarily. Not like you would think on a day where the Dow's up 134, the NASDAQ's up 66. The SOX is up, the Russell's up, the S&P 500 up. So watch this, but it's still overbought. But you would have thought we would have seen some type of sell-off maybe down to here, but we didn't get that. But for the next few days, I still suspect it's too early to short unless something bad out of Europe comes out. Let the market exhale a little bit, let it bounce a little bit, and then perhaps look to add some shorts back in. And I don't mind you making some longer-term buys for some really good stocks, but just keep in mind that if the market gets nasty again, as you've seen in the last few days, those stocks will go down. Apple did go down. It was the best stock, right, for all of this year up until April. And when the market got bad, so did Apple, or vice versa. But the bottom line is, great company that got hammered. So watch it. And but if you want to make some of these long-term plays because they're cheap, that's fine. Just realize that you may have to add more hedge to kind of neutralize your position. All right, folks. We'll talk to you soon. Don't forget KarlEggers.com. It's the blog. I do some articles on there, podcasts, a free email subscription up in the top right, Twitter.com/Karl Eggers, plus Karl Eggers on Google+, and we also have EggersCapital.com. Have a good evening.